Good evening to everyone in Southeast Asia, and greetings to everyone else who is joining us from other parts of the world. My name is Peter Godfrey, and I'm based in Singapore, from where I represent the Energy Institute as Managing Director of Asia Pacific. It's my great pleasure to be moderating our session tonight entitled A Reversal of Fortune, Oil and Gas Prices in a 2-Degree World, although when one looks at the BP's results announced today, and the return of a raised dividend, the question is whether there really is a reversal of fortune. So I look forward to the session. It's presented by one of the world's leading natural resource research and consultancy businesses, Wood Mackenzie, that have been providing industry with quality insights for almost 50 years. But before we get started, just a few housekeeping issues. There will be a Q&A session after the presentation, so please use the chat feature to make any comments you wish to. I will then try to weave those into the conversation after the presentations are over. Please ensure that your video cameras are disabled and mics are kept on mute throughout the session. And for your information, the whole session will be recorded and made available through EI's YouTube channel to registered participants of the event, and you will be invited by a follow-up email shortly after the event takes place. So without further ado, let me make a very brief introduction. As the world cranks up to its efforts to limit global warming, the consequences for the oil and the gas industry will be severe. Wood Mackenzie will show how energy demand and supply are likely to shift dramatically in the face of rapid policy and technological change to cut greenhouse gas emissions in line with the Paris Agreement and follow-on agreements that I'm sure will take place in COP26 in November. As I believe they will show, the implications of a scenario akin to the one that they have analyzed, their 2-degree scenario, the findings are profound and far-reaching. So without further ado, let me introduce our super lineup of speakers for today's session. Firstly, may I introduce Simon Flowers. Simon has been chairman of Energy for Wood Mackenzie since April 2016. He has led the commodities, global trends and corporate analysis research over the last few years and has been chief analyst since July 2015. Simon also writes his weekly The Edge publication, which if you're not on the mailing list is well worth reading because he always has great and insightful comments to make. Secondly, may I introduce Alan Gelder, who's Wood Mackenzie's VP Refining and Chemicals and Oil Markets, responsible for formulating research outlooks and integrated cross-sector perspectives on the global downstream sector. And Alan joined the Wood Mackenzie in 2005. He has managed consulting assignments all over the world, focusing on major transactions, projects and M&A activity, and their alignment with key success factors for industry players and third parties. He then transitioned into research upon his return to London from Houston in 2011. And lastly, but not leastly, may I also introduce Katerina Filipenko, who joined Wood Mackenzie in 2012 as a member of the upstream research team focusing in on Russian gas supply projects. And in 2019, she moved to the global gas and LNG team and is now responsible for the gas supply view with a specific focus on Russia, Central Asia, and Europe. So without further ado, may I hand over to Simon, who is not yet on the screen. So Simon, if you can please put your video screen on and also demute yourself. And hopefully, Simon, you can introduce the session. Thank you very much.
Peter, thanks very much. I'm grinning from ear to ear. I think I need Will to start my video. It says the host has shut me down, so I think he might need to switch me back on. Thank you, Will. Excellent. There we go. Grinning indeed. Thank you for that kind introduction, Peter. And it's an absolute pleasure to be able to share our evening with EI and you, in all over the world, but I suspect mainly in Asia Pac. And our team over the next 50 minutes or so is going to talk about how we see the energy mix for oil or the energy mix changing over the next 30 years, and particularly how it means for what it means for oil and gas. Now, lots of people do that. ExxonMobil, Shell, BP, etc., OPEC, the IEA, and what have you. What we've done is gone a step further than most and modeled how we think price plays out. So that's the gist of what we're going to talk to you about, as well as the implications for those. Many of you may have seen that the IEA came out with its net zero emissions numbers about a month after we did. We published this in April, IEA came out in May, and it's a little bit different to us, but let us talk you through ours, and we're looking forward to lots of questions from you. Next slide, please. Alan, are you driving us? Yeah, I wanted to ground you in how we look at the world. So we've been publishing oil, gas, and other commodity analysis for nigh on 50 years now, and it's centered around our base case, or what we now call the energy transition outlook on the left-hand side. And that's gained a lot of credibility over the decades because it's bottom up for every energy market in the world. And it's also top down on supply across all mixes of energy, all types of energy, as well as metals and mining. So that's our base case, and it comes out broadly equivalent to around 2.5 or 2.7 degrees C global warming outlook. Not good enough to save the planet. So what we also do, of course, we've built two scenarios, and the one we're going to focus on today is our 2-degree scenario. It's a very different proposition to the base case, in so much as we look at what has to happen on the demand side, but also supply side, for the world to get onto a 2-degree or lower scenario. We assume in this, of course, that developed countries reach net zero by 2050 and the world reaches net zero by 2070. So that's the introduction. You'll hear mostly about 2-degree scenario in this presentation. Next slide, please. So a little bit of the high-level macro introduction from me. So the world is plotting to get onto net zero, and we've seen we know what we have to do to get there. We have a carbon budget of about 740 billion tons to eliminate by the end of the century. And we've started to see countries move rapidly to get onto a net zero path, or at least to declare the target of net zero. We saw a cluster of countries towards the back end of last year, China, Japan, South Korea, doing that, following the EU and other ones which were already there. And you'll see on the right-hand side that it's a very, very steep change that needs to happen, and it needs to happen very quickly if we're to get onto that 2-degree scenario. So that gap you see between the light blue, which is our base case, and the dark blue, is shifting rapidly over the next 30 years to a low carbon world. So it's easy to plot a graph, it's a lot harder to actually make it happen. One thing that's pleasing in policy terms is that we're starting to see countries realize this. So 2050 is a long way away, and many countries have started to come up with intermediate targets around 2030 or 2035, but we've yet to see the pieces of the jigsaw slip in underneath that to show how we're going to get there. We'll talk about some of those when we drill down into the different commodities. Next slide, please, Alan. So carbon reduction, how do we do it? Well, there's many levers that the world can pull, but a big one is going to be electrification. The power sector is going to be very important with renewables growth, with getting rid of the dirtier end of the fossil fuel chain, particularly coal, and gas becomes quite prominent. And of course, we need new technologies, or at least technologies that aren't commercial yet. That's carbon capture and storage and hydrogen. They're going to be a huge part of this. And what we're showing in this chart is the effect of that rapid electrification, these other factors, how we get the carbon emissions down from just under 35 billion tons per annum down to the levels you see by 2050. So the world will still be emitting carbon capture, we'll still be emitting carbon by 2050, but we will get quite close to net zero, not quite there. Remember, it's 27 that we're predicting it, by using carbon capture and storage, sinks, and other negative uses. That red line you see at the bottom of there, netting off the emissions from sectors that we're struggling to fully decarbonize by 2050. So it's a net target, as is in the net zero emissions that you see. So that's how we see it across the residential, commercial, and agricultural sector, transport, power, and industry. And each of these will happen at different times. Power is good to go. Renewables are happening now, and energy storage is building up rapidly. Some of these other sectors are going to be a little bit harder, and they are going to start getting towards net zero in the 2030s and 2040s. Next slide, please. It's not going to happen on its own. So we need policy, we need technology, we need investment. And a key part of that policy is going to be a carbon price. So as of now, the global carbon price, the average global price for carbon around the world in the regimes that do have a carbon price is only about $20 per ton. So we need more countries to adopt it, and we need much higher carbon prices to incentivize the shifting from fossil fuels into low carbon and zero carbon technologies. So some technologies work around the current price. You'll see some of these carbon sinks, these forests that can work. But when you move up on this right-hand chart to the upper end of the scale, some industries, including power, but also industry, think about cement, think about steel, think about fertilizer, they need a three-figure sum. And in fact, some elements of industry are going to need $200 per ton. That's our view. So what we need from COP26, or an aftermath thereof, is to see more countries adopt carbon pricing. It'd be nice to have a global price, but a bit of a question as to whether that's actually realistic in the near term, but carbon price is needed. Next slide, Alan. And with that brief introduction, let me hand over to you, Alan, to talk about the oil.
Thanks, Simon. Just a reminder from Will, no doubt there'll be lots of questions for Simon and questions for all of us as we go through, and please put those in the chat function and we'll try and do as best as we can to address them at the end. So just before I get started on the oils and refining topic, just want to really highlight the distinction between our base case, which we term the energy transition outlook, which is an integrated cross-sector view, bottom-up analysis, country by country, and looking across oil, gas, battery, raw materials, all those things to pull together what we think is a most representative view of the future. This, as Simon mentioned, accelerated energy transition is top-down and it's deterministic. And what we've done is used sort of key levers to really change the demand trajectory and hence the emissions trajectory from the various different sectors. If we look at oil and sort of look at oil first, then sort of looking at the left-hand side, our base case oil demand outlook is one of sustained slow growth from where we are now, hitting a broad plateau just under 110 million barrels a day in the mid to late 2030s, and then a decline. And that's really reflecting the fundamentals of improving fuel efficiency, but global population adding almost 2 billion people, and global economic activity effectively doubling from 2019 levels by the time you get to 2050. So that's got a much bigger call on energy requirements. Our electrification in terms of sort of EV and new car sales, 2020 was about 4% of new sales. We've got that growing steadily, so it's over 20% by 2030 and continues to grow. And if we look holistically across sort of the oil segments or the sectors which consume oil, petrochemicals is the one that remains the key driver in our base case over the long term, showing sustained growth, whereas we have declines in gasoline and other road fuels as a result of electrification or alternatives. In our accelerated energy transition, what we've done is we've really brought electric vehicle penetration forward significantly, where the scenario is based on sort of the virtuous circle where electric vehicle batteries, the technologies continue to improve, evolve quite quickly. Manufacturing capability continues to be built out quite strongly, as we've seen over recent years. And we have a virtuous circle where the governments, OECD governments, are able to achieve their bans on internal combustion engine sales in the late 2020s, or arguably earlier, and the system builds from that point forwards. We also get faster penetration of alternatives or faster electrification in those hard to decarbonize sectors, such as heavy duty trucking and those sorts of things. So electric vehicle penetration achieves sort of 30% of new car sales within the next few years. And by 2050, over 80% of the global car stock is electrified. This you can see in the sort of the chart on the right hand side, where that's showing the oil demand reduction by sector. And you can see the significant reduction in oil demand that we have in the transport sector. We've got similar, slightly less demand reduction for industry and petrochemicals. Petrochemicals, it's really about technology breakthroughs on recycling, and industry, it's just a general theme of decarbonisation and adoption of lower carbon fuels. But the impact on oil demand in this scenario is really dramatic. What we have is oil demand in 2050, rather than being of the order of 100 million barrels a day, high 90s, is actually around about 35 million barrels a day. And so what we've got is, within the next few years, oil demand has hit its peak and is falling at 1 to 2 million barrels a day each and every year. That has quite profound implications on oil supply, or the need for oil supply, and pricing. So if we go on to that, based on that demand view, at a very high level message, we've got all the oil that we need is known and is currently commercial. There's little or no need for additional exploration activities. What we've done in terms of our modelling for sort of oil supply and oil price is we're looking at what sources of oil need to be brought on to satisfy global demand, and we're looking for the lowest break-even source of supply with that pipeline of projects that we know are underway and drilling that is currently planned. What we have then is actually an oil supply system that follows the demand profile. But what we have is a significant moving away from high cost sources of oil supply. As a result of those projects simply don't take place. So high cost sources of supply, new reserves, undiscovered, yet to find sources of supply are not tapped. And what we have is oil supply becomes increasingly dominated by those low cost regions, which are the current OPEC countries, Gulf of Mexico, North America, plus also Russia. The big losers are those high cost locations, West Africa, deep water West Africa, those sorts of places where the investment is not going to be commercially viable. So what this does is it concentrates oil supply on those low cost regions. And so what our expectation is that OPEC gains market share. This you can see quite clearly in the chart on to the left-hand side, where the OPEC group of countries in that yellow becomes a growing portion of the overall supply mix. And by 2050, OPEC's relative market share achieves about 50%. that normally would have profound upward implications for price. Actually, our price trajectory is one of decline. It's not steady, it's not linear, and that's because we're looking at what's the cost of that well that needs to be drilled to satisfy supply. Within our oil supply model, we've got sort of year-on-year volatility. So this is showing sort of 3-year averages. But what we're looking at is oil prices falling to the low 30s within the not long after 2030. A challenge at this point is stability of the Middle East, those sorts of regions that we factored in. If we look at the region around the early 2030s, 2032 to 2035, we've got prices rising, and that's because we've materially reduced the production volumes from Iraq as we fear for the stability of Iraq in such a price environment. The challenge here, though, is with oil demand declining 1 to 2 million barrels a day each and every year, OPEC's ability to restrict supply to hold prices up gets rapidly eroded. And so what we're looking at is oil prices falling to below $20 a barrel post 2045. And it's really those low-cost sources of supply from the OPEC countries become last one standing in satisfying that global demand outlook we have for 2050 in this scenario. So it's a very dramatic decline that we're expecting for oil price. I move on to refining. The implications for refining are even more profound. The refining system has got too much capacity. We've seen extensive rationalization, but it's set up for a world where demand continues to grow quite strongly and comfortably over 100 million barrels a day. Refining profitability is driven by asset utilization and crude oil differentials, both of which were severely impacted by the pandemic. Very simply, if we have oil demand declining 1 to 2 million barrels a day each and every year, then we need to close 5 to 10 refining sites each and every year. What this means is refining margins will be weak and consistently weak as it needs to drive that rationalization of existing capacity. Not all products will be the same in terms of their crack spread outlook or their premium to a reference crude such as Brent. The electrification that we have is very much focused on the passenger car segment. That's what's leading first. That's where we see the strongest decline in demand for fossil fuels. And so what that means is gasoline crack spreads will be particularly weak, and along with it naphtha, because even though we've got petrochemicals growing, we've got faster penetration of chemical recycling, those sorts of things. So light distillates will be very weak. Middle distillates such as jet and diesel gas oil will be relatively stronger because there will be a greater desire for those due to the slower decarbonisation of the heavy-duty trucking sector. Fuel oil will be more balanced, so there will be advantage in having more sophisticated refineries. And then it comes down to who are the sites that are going to survive this environment the best, and that's where we get into our assessment of competitive position. So for those in the refining industry, it's well known that refining is quite special. Each and every asset is unique. And we've got lots of different metrics that we benchmark the refining industry on. But in terms of competitiveness, we're quite straightforward in that we just choose to look at site earnings. And here we're looking at the earnings by each refining site, dollars per barrel. We term it net cash margin, so that's after cash costs for all sites over 50,000 barrels a day, where we've coloured the region of which the refinery is in by different colours. So what you can see on this chart is there is a piano curve where there are a number of assets that are cash positive a number that are cash negative. The shape of the curve doesn't really change by a particular year. The profitability, general health of the industry determines how many are profitable. So above the line, how many are cash negative, loss making, and so below the line. There's two features here. Some of the most profitable sites globally are the left-hand side of the chart. They're in North America. They're actually in the US Midwest or in Western Canada, where they have advantage crude because the crude is actually is on its way to the Gulf Coast from Northern Canada, and so they capture a crude pricing advantage by virtue of their location, but also they have a product pricing advantage because those regions are typically deficit. Normally in economics would say some of the most competitive sites will be those that are best able to withstand adverse conditions. However, we challenge that in this case, in that if demand is falling dramatically within North America, what is currently an inland advantage could well switch to an inland disadvantage if there is more refining capacity and local demand as a result of electrification. What that means is actually in a rapid electrification case, in our accelerated scenario, we could see rapid consolidation of what are currently highly attractive sites in North America. If you look at the chart on the right-hand side, there's also a number of sites that are cash negative. These are primarily Middle East and they're in Asia, and they're there not to generate cash, not to be profitable. They're primarily owned by national oil companies as a government stake. They're there for employment, security of supply, and so are cash negative. In a world that is rapidly electrifying, will the government choose to bear the costs of satisfying that supply or providing that security of supply if those supplies are not necessary? So this view of competitiveness gives us signals to how we expect the world to change, but you must look at the unique factors at either end. So what's our outlook? So what's our forecast? If we reduce crude throughputs to satisfy the overall demand for oil products in 2050 of around 35 million barrels a day, then arguably the world only needs 150 of the 700 or so refining sites in operation. So we're looking at extensive rationalization from the coming few years all the way through the period. The refineries that will be marginal, those that are making zero money, will become increasingly sophisticated as the less competitive assets shut. If we look simply as to what could this mean, if we compare refining margins in 2050 to what we had, it could well be that refining margins are $5 to $6 a barrel lower than they were in 2019. All our reference indicators would be negative at this point. And the assets that we think will remain are coastal, highly integrated refinery and petrochemical sites. We think they will be the ones that are able to sustain this existential threat that rapid electrification provides to the oils and refining sector. With that, let me hand over to Katerina to take us through the global gas and LNG perspective. Gotcha.
Hi, thank you, Alan. So the story for gas and LNG is a bit more positive than for oil, and mainly this is because of gas's low carbon footprint, and this effectively helps support gas demand, even in the 2-degree scenario. So if we go to the first slide, so here we're showing the global gas demand by scenario, and the key message here really is that gas demand is resilient. And it is resilient because of 3 key factors. So first of all, we assume that over the next 15 to 20 years, coal to gas switching will be the cheapest way to decarbonize Asian economies, particularly developing Asian economies, which are still significantly reliant on coal. The wide-scale development of CCS and CCUS project is another key assumption in the scenario. the CCS will be widely used to support gas demand in those sectors that are hard to decarbonize, for example, in industry, in steel production, in cement production, and so on. It will also be used in power in the long term, particularly when gas will be increasingly associated with the CCS, when it will need to provide additional support to renewables longer term. In this scenario, we assume about 5 billion tons of CCS development by 2050. And out of these 5, about 4 billion tons are associated with gas. So they help in support gas demand. And this roughly helps secure about 2,000 billion cubic meters of gas demand by 2050. So looking at this chart, that basically tells you that CCS helps to secure about half of gas demand in 2050. And the third factor that helps support gas demand is also in a way linked to the CCS developments, is the development of blue hydrogen and the use of gas as a feedstock for blue hydrogen. The blue hydrogen in our scenario represents a commercial opportunity for gas. In this slide that we're showing here, this wedge, the red wedge that represents blue hydrogen, half of it is effectively the gray hydrogen production that will be retrofitted with CCS facilities, and it will turn blue. And then another half is the new blue hydrogen developments. But really, the strongest driver of gas demand and the strongest support of gas demand in our 2-degree scenario is gas demand in Asia and the coal to gas switching in Asia. And we assume that it also translates into very robust LNG demand in Asia as indigenous production declines and the piped import options are more or less limited. So pipe import options in China, for example. So if we now go to the LNG demand specifically, on the next slide, we see that it continues growing strongly through 2030s. And mainly this is supported by the demand growth in Asia. But after that, it flattens as global LNG or global gas demand slows down and the LNG demand plateaus and even starts declining in a little. So on this chart, this is our classic chart that usually shows the need for new LNG developments. So the light blue wedge here shows the post-final investment decision LNG supply view. So basically, all the LNG supply projects that are either on stream or have entered construction phase. The lines here show the global LNG demand view in our base case in the 82 scenario. And as you see, this gap doesn't open up until 2030. So that indicates that the market is well supplied until 2030. And after that, new supply is needed. And moreover, our model indicates that new supply is needed over and above what low-cost producers like Qatar and Russia can offer in this time frame. So what this means is that we expect that the market will call for new expensive projects, more expensive projects. And probably this would be developments from the US, and they will be needed to come in and to fill this gap. Now, I have to say, it doesn't have to be the US. This is what our model suggests us based on the cost analysis, cost optimization analysis. But in reality, the capital flow will define where this LNG will come from. But the key message here, the key takeaway of this chart here is that this extra LNG will be needed wherever it comes from. And this also means that the prices will have to rise to incentivize this new supply. After 2040, we see that the LNG demand flattens, so the competition will intensify as we enter this demand plateau. And market space for new projects will become increasingly limited, and only the most advantageous projects will be able to go ahead. So now let's look at how this impacts the key LNG suppliers. If we go to the next slide. So here we show the LNG production of key exporters in our base case on the left-hand side and in the 82 scenario. And as you see in the base case, the strong LNG demand that continues through the outlook means that there's enough space for countries like Russia, Qatar, and North America, the North American region to expand. But in the 82 scenario, the story is slightly different. As we mentioned, the new supply is needed in 2030. So we see this bump in US LNG development, so additional developments are required. But later on, the market becomes more limited. And the second point on this chart is that we assume that low-cost producers such as Russia and Qatar will continue expanding through the outlook. Basically because they will try to avoid stranded resources, because the economies are still reliant on hydrocarbons, and it will most likely continue. And we see that in oil space, for example, OPEC will be likely losing some market power, but in the global gas market space, we see that the market becomes more concentrated, and we see that countries like Qatar and Russia are likely to gain more market power. And in fact, by 2050, we expect them to capture about half of global LNG market. So again, back to this chart, as LNG demand flattens out in the long term, Russia and Qatar continue expanding, and this means that there will be a clear oversupply of the market towards the end of 2040s. And there's a possibility that market will have to balance again by underutilizing some of the existing developments. So for example, in our case, US LNG, which is similar to what we saw last year effectively. So this now brings us in nicely to the North America story, which is actually one of the most interesting outcomes of our analysis here. So if we go to the next slide. So in North America, there are different dynamics in play. So first of all, on the demand side, domestic demand in North America and the need for gas exports are lower than in our base case. But they're still relatively sustained through the outlook and only start declining towards the long term. Now, on the supply side, the supply dynamics is strongly related to the low oil price view in the 82 scenario. So low oil price means that we will see less associated gas in our 82 scenario than in our base case. So in the middle chart, the green line shows associated gas production in the 82 scenario versus the red line representing the base case. But this in turn means that to sustain this demand through the outlook, the new, more expensive dry gas developments are needed. And on the right-hand side, we show that at some point, our dry gas development production is even higher than in our base case. And what effectively means for prices is that more expensive dry gas supports Henry Hub through the outlook. And that means that Henry Hub view is quite strong through the whole outlook in the 2-degree scenario. So if we now go to the prices on the next slide, as you see, Henry Hub here is quite strong through the medium term when more dry gas is required. It does start declining towards the long term as demand declines further, but it still remains relatively resilient. But looking at the global prices through the outlook, we see a lot of similarities to our base case. So one similarity is we already see the next price cycle. The prices are very strong over the next couple of years as demand recovers, and they soften in late 2020s as new supply is arriving to the market. But similar to our base case, we see another wave of prices that reflects the need for additional developments that we discussed earlier. So in 2030s, we see that the prices will have to rise to accommodate this new LNG supply. And this is basically the window of opportunity for LNG producers. And post-2040, only post-2040 as low-cost developments continue expanding and as global gas demand is declining, we see that the prices are going down, which effectively means that some projects may have to be underutilized. So now, before we move to more broader cross-commodity implications, I would like to highlight a key prerequisite of the scenario on the next slide. Please, thank you. So we believe that this outlook for gas demand is not possible without the change in the business model. And this change in business model is necessary for producers to maintain margins. It's necessary for their ability to raise capital when there's low carbon pressures. And we assume that gas and LNG producers will continue prioritizing or increase their focus on reducing scope 1 and 2 emissions. They will start looking for more low cost, low carbon, clean supply as carbon prices increase further. But in this business model, we expect that there will be even more focus on reducing or managing the scope 3 emissions. And to successfully manage scope 3 emissions, you need to start trading carbon credits, work with offsets, and so on. In this model, managing scope 3 emissions through CCS becomes really an integrated part of the new strategies, gas and LNG strategies. We think carbon neutral gas and LNG will go mainstream. And we also believe that the monetizing of this CO2 creates a lot of opportunities for companies, and particularly downstream, including things like synthetic gases. So effectively, in this business model, sales don't stop, gas and LNG sales don't stop where gas sales transaction is completed. They continue through trading carbon. So the carbon really becomes at the heart of this business model. And now I pass it over to Simon to talk about cross-commodity applications.
I can control my own destiny again. Thank you, Katja. Yeah, I'm just going to wrap up with a couple of slides. Next one, please, Alan. So we talked a bit about prices, and we've looked at the oil price and the gas price. But what about the interplay between these two? Through my career and many others, I dare say, on this call, gas is always traded at a big discount to oil, and we're showing that on the left-hand chart here. In the period 2010 to 2020, it's traded at about a 75% or 75% of the oil price on an energy equivalent basis. And if you track the light blue columns through time, through 2030, 2040, 2050, in our base case, that remains the case. We see oil demand pretty robust. The price of oil holds up because we need more expensive new supply to meet future demand. But in the 2-degree case, it's very different. As Alan described, we see weakening oil demand and much more resilient gas demand, as Katja described. And so we see this reversal of fortunes, as we titled our paper. So we're looking at the Asian LNG price as a percentage of Brent, and in AET2, you see that price moving to not just a spot premium, but a sustained premium. And if that does prove to be true, of course, it helps incentivize the new investment we're going to need to deliver some of those quite expensive projects that need to be developed. So bullish for gas, bullish for LNG. And then on the right-hand side, Henry Hub with the discovery of fracking, essentially, but first of all, gas, a lot of gas resource, but also a lot of cheap associated gas resource with Titan has suppressed US gas prices to a massive discount. You're often trading at 20% of the oil price on an annual average basis. But as Katja explained, the weak oil price means that there's much less motivation for tight oil drillers to drill the Permian and the other tight oil basins. And as well as tight oil, of course, there's a great deal of associated gas, which essentially comes free and is filling feeding the market at the moment. But that source of cheap gas will dry up. And through time, we need to see more expensive gas in the US developed to meet market demand for the power sector and other applications for gas. So there's a massive revert. The fact that the turnaround in US gas prices in our model is considerably more than it is for Asian LNG, as you see over the next couple of decades. So this is the reversal of fortune that we're talking about. Gas becomes the premium of the two fuels. Next slide, please. So all very commodity driven so far, but we want to sort of come to some conclusions, including what it means for companies. So a lot of information here, and I'm just going to pick out, you probably see the ones I've bolded here. So it means a lot for oil supply, and just to repeat that we don't need much new oil supply because there's plenty of existing resource, but a lot of it is quite high cost, a lot of it is quite high carbon. So new discoveries that are low cost and low carbon can still push their way in. And that's something that the IEA didn't really touch upon in that case, but we firmly believe that that's the case. And one of the majors that's come to our attention just in the last couple of months is setting up, or has just set up, a new venture group in exploration to look at new basins and new opportunities, which we think is quite encouraging. It suggests that the oil industry still sees exploration as part, maybe not as big a part as it's been early this century, maybe it's a dwindling part, but it still has a part to play. On the second vertical, we've already talked about OPEC losing its grip on the oil market in a 2-degree scenario because demand is falling so rapidly. But it also opens up a huge opportunity in the gas market. The growth of supply into the international market from Qatar and Russia potentially allows them to exert power in that market. The opportunity is there for sure as their market share increases. So that is of geopolitical interest as well as interest to the oil and gas market. Downstream, Alan's covered a great deal here, and I was just going to touch upon the refineries that will close. Alan's touched upon, but the ones that will stay in the market longest will be close to the markets that last the longest. Many of them will be in the Asia Pacific area and other developing economies. They'll tend to be integrated refineries which are integrated with petrochemical facilities and producing low carbon feedstocks and very low carbon operations. So we've not used the phrase scope 1 and scope 2 emissions, but all facilities, whether upstream or downstream, will have dealt with scope 1 and scope 2 emissions as best they can. Otherwise, they'll struggle to stay in business. The gas price we've talked about, so gas moving to a premium means that you'd expect capital to shift heavily towards natural gas rather than oil. And you'll see here the figures. We expect massive investment of $400 billion in total in new LNG developments and dry gas in North America just to meet the future demand under AET2, supported by the relative premium price that we're talking about. So it's good news for gas players. And the final point I'll mention is just on the right-hand side. What does it mean for oil companies? Well, that point about investment isn't happening yet. Okay, so roughly 2/3 of all investment in upstream is going into oil still. There's a good reason for that, in that you can make more money. The returns are quicker and they're typically higher in oil projects. And it's tough making money out. It's tougher making money out of gas. It hasn't happened yet. Many might say, well, why would it happen in the future? Well, it probably needs that those incentives we talked about, plus this shift in pricing to tickle that movement along. But we actually think it will happen. And maybe the final words from me is that we're not really seeing companies adapt their their strategies towards this sort of scenario. Many might think it's extreme, but it's actually quite plausible. People will quibble about the timing of it, but at some point over the next half century or so, we're going to see dramatic movements like this. And we're yet to see companies, they talk about it, they embrace it, but their strategies haven't really shifted that way. And I'd be very surprised if we don't see quite significant movements towards this direction over the next 5 years. And although COP26 doesn't really have corporate implications per se, you know, it may well be the catalyst to see things moving on a bit more quickly. And with that, Peter, I'm going to hand back to you as moderator. That's the end of our formal presentation.
Well, thank you very much, and lots of questions to ask. And I guess I'd like to start by sort of raising two issues. You, Simon, just talked about the pace, and you know, the pace of company change, the pace of adaptation, and that raises some questions around what the pace is. And you know, firstly, I'd like to start off with one of the core underlying issues, which is obviously the price of carbon. You know, obviously, unless the price of carbon plays a core part in that transition, it's difficult to see the pace increasing and companies really changing at a pace that is needed, even for a 2-degree scenario. And let's face it, it is just a scenario. Some would argue, and we'll talk about it afterwards, that 2-degree scenario is not nearly fast enough. In fact, we need to think about what is now the objective, which is a 1.5-degree scenario, or even lower, if possible. You know, if one believes what the climate scientists are saying, which we'll talk about. But let's start off with the price of carbon and what your assumptions have been for your particular scenario that you've developed around the 2-degree scenario, and how you think that will sort of interplay with your future forecasts and your future work related to, you know, the pace of change in CCS and everything else that hopefully will come along. Simon,
yeah, it's a fundamental question. So let me try and tackle that head on. So we don't assume a global price of carbon in this model. The model assumes that society adapts and adapts to new technology on the consumption side, and that technology makes leaps and bounds in terms of economies of scale, reaching industrial scale in the new technologies, you know, renewables obviously, but carbon capture and storage and hydrogen, and it happens on its own. So I think the point about carbon is almost political, really. Can the world get together and deliver a carbon price that makes things faster and maybe even makes things steeper, so that we get closer to 1.5-degree pathway? You've seen what we think is needed. You know, $50 per ton, or it's $60 per ton, roughly 55 euros per ton at the moment in Europe, is a pretty good start. That price has more than doubled in the last year. But we think it needs to be somewhere in the $50 to $100 per ton range globally if that's going to happen. And if you can get some sort of agreement coming in the aftermath of COP26, we could get onto a 2 degrees, perhaps even lower scenario. But you know, it's glib just to say that can happen, because it requires so much get together, so much cooperation and collaboration among the different countries, among the different regional groups to make it happen. So we've seen the Europeans take a halfway step. So they, of course, have their trading system in place with that price I mentioned of roughly 55 euros per ton, and so as to continue to push towards their net zero ambitions, and to make sure that their industrial sectors aren't disadvantaged, discussing and making policy towards introducing a carbon border adjustment mechanism. So if you're a steel producer in the Philippines or the US, you can't just dump your cheap steel into Europe. So I think we're at the beginning of this process, but I would wager that it's going to take all of 2022 and perhaps, you know, into the middle of this decade to get a proper agreement on carbon pricing. But it's needed.
Do you have a view on COP26 and what could be achieved or not at this stage? Is it, you know, obviously it's a very highly political subject, but from an analytical perspective, do you have a view in terms of what you would promote at COP26 as a realistic possibility?
So I think the template is what we've seen, particularly from the EU again, where they are setting absolutely clear targets for 2030 and introducing the policy to help them achieve that. Now, if we drill down a little bit, the specific goal of COP26 will be to set nationally determined contributions for the next 5 years. And in those, we would expect to see pretty granular targets for reducing carbon emissions from the economies. So we're talking not just about the supply of power and the supply of energy, we're talking about changing consumer behaviors, and the mechanisms to achieve that are many, including efficiency gains, including taxation, all sorts of carrots and sticks. I think beyond that, it's difficult to say. That's broadly what we're expecting, but a great deal of granularity has to be added to that concept for us to feel confident we're going to get remotely near a 2-degree scenario. Alan, would you like to add anything?
Simon's not much to add on that, I think, really. Carbon pricing is a real challenge. We need to see what the NDCs are, and if we're going to achieve a 1.5 degree C world, we need to see some aggressive targets being set and some near-term metrics to ensure they're not all 2050 targets. They need to be 2030, 2035 to really give some assessment of progress.
Well, if I can say one more thing. So it's a model. The scenario is based on a model, and it comes up with, if you can all remember, one of the early, in fact, Alan's first slide about oil demand falling very rapidly from after 2023, I think it is, and what that requires is very rapid penetration of electric vehicles and all that goes with it. So the supply of power, the charging mechanisms, all that kind of stuff, and it could be, because of the model, it could be we're too early, and we'd agree with that. It's very, very ambitious what we're showing here, but if you look at the sweep of it through to 2050, it's entirely possible that, so long as the right policy decisions, investment decisions, technology things progress, that you can get onto the track that we describe through the course of the next 10 or 20 years.
Let me ask another very big sort of ticket question. I often talk about the decentralization of energy, the fact that, over the past 100 years, we've lived in a world where the multinationals and national oil companies have created a globalized energy market. When we start looking at the introduction of renewables and new energy and different forms of electrification and EVs and hydrogen, et cetera, we're beginning to see a much more regionalized approach to the way we drive and manage energy going forwards. So we've talked today about, the US, about OPEC, about Europe, about refining and petrochems and supply and demand. But there is another argument here which says that actually global scenarios may well be breaking down, and we may be entering a world where increasingly regional pull will drive the way energy systems develop, also from a geopolitical standpoint. What's your view regarding that statement?
I think it's absolutely right. So, the future is electricity, which is not easy to transport over long distance. So, local is good. So you started to see that all over the world in small scale at the moment. Even in places like Texas, where you've got substantial renewable energy, you've got a lot of domestic appliances, solar appliances. There's rapid movement in energy storage, and it's making life difficult for the traditional utilities to manage that. And I think that is how it'll go. And the great thing about it is for those countries that have access to renewables, because not everyone does, but if it's sunny or windy, onshore or offshore, that's a tremendous resource to have. It's security of supply for you in a way where you're not as dependent as the old exporters of of fossil fuels. So that's one part of it. But the mix in the future is going to be quite complex, because you're going to need swing power, and that's why Katja talks about gas being really important. Through the transition, and maybe even longer, gas with carbon capture and storage is important. So some countries will still need to import their gas. Oil, I think, will be asked quite a long time, a dwindling amount for the foreseeable future. And then you come to the sort of sexy new stuff like hydrogen. And hydrogen could be a really wonderful thing. We don't think it's going to be commercial in very large scale until 2040, but who knows? Who can believe the pace at which solar has prices have collapsed, or cost of solar has collapsed in the last decade. But hydrogen is a really interesting one, because not everybody is going to be able to make low-cost hydrogen, because you need super cheap renewable energy to do it. And this geopolitical thing comes pretty interesting there, because you may see the new Saudi Arabias of hydrogen emerge, very sunny places with a lot of cheap electricity, able to do the electrolyzation and electrolyzing and export hydrogen. So I broadly agree with you. I think it's going to become more local, and in many respects that's really good, because it can be low carbon. But I think there's still going to be an international traded market in energy of various sorts for some time.
And Alan, let's just pull over to you a little bit to talk about the refining and petrochem sector here, because again, you talked about it to a certain extent from a global perspective. Obviously, national markets, if they do regionalize more, may actually take a slightly different cut on a broader global focus around how they deal with the refining and petrochems markets. Using your crystal ball, how do you think that might sort of emerge in the future? Because clearly there is a localized element here within the refining petrochemicals world, as well as a global one.
Like I say, it comes back to a point I would have built on from what Simon said. The issue with a regionalisation of any sector is the emissions are still global. And so if we have a region such as Europe that wants to decarbonise rapidly, and the rest of the world is not, the implications of that go beyond energy and into sort of regional energy and into trade. And so where you've got different regions with different aspirations, that's when you can start to see things like carbon border adjustment mechanisms being put in place to try and extend the climate change aspirations of one region into another. That depends very much as to whether they are effectively a net importer or a net exporter of energy. So the issue,
absolutely, and we certainly will be relating that back to both the STO and the LTO teams.
Hello, somebody's breaking in. Can you mute yourself, please? Thank you. Carry on.
Right. So for the challenge for refining is it is a truly global industry. There's some work we've done on sort of general emissions in preparation for sort of the threat of a carbon border adjustment mechanism that Europe could have been putting in place. And if you drew the boundary line from the refinery gate through to the consumer, then actually a carbon border adjustment mechanism could well help European refineries, because the emissions from European refineries are relatively low compared to sort of the places that are exporting products to Europe, say Saudi Arabia or Russia. However, if you look at the entire value chain, it gets more complicated, because European refineries are processing more West African barrels, more WTI that's come further. And so actually, if you look at it from sort of well to wheel, I think for scope 1 and scope 2, actually European refineries wouldn't necessarily get much protection from a carbon border adjustment mechanism. So the challenge with any of those things is where you draw the boundary within a region, but directionally within a region where demand is falling, then the refining industry will be challenged. It needs to export its surplus. If those markets aren't present, then you end up with low utilization and a challenging time.
Great. So let's move this to this region, or my region, right? You know, I know you're sitting in a different part of the world, but actually the Energy Institute is running an event for its Generation 2050 initiative, which is young professionals in September as part of the pre-COP26 run-up, entitled, "Is the Rise of APAC, the Asia Pacific region, the world's biggest climate conundrum?" Which you can argue it is, in that obviously there are growing energy markets. You talked about Europe just now, and obviously declining markets. But if you look at Asia, APAC, it's a very different story. I mean, we have rapidly increasing requirements for energy. And, you know, however much you do with renewables, it's hard to catch up with that, let alone deal with coal to gas switching and whatever other technologies one wants to use for energy. So I ask you the question, I mean, is APAC a different, is there a different solution to the APAC question and how it is handled within the context of climate change to the West, where we have narrow growth markets, if growing at all, and a very different set of underpinning dynamics behind it? That's, you know, to me, a fundamental question we need to ask.
Yeah, Katja, do you want to have a go at this? I leave to me. Would you like to start?
Yeah,
I'm sure
yeah.
So
yeah, absolutely. The rise in energy demand in Asia, and particularly in Asian developing economies, is presenting a massive challenge to the decarbonization efforts globally. And in fact, in our 82 scenario, we don't see the world reaching carbon neutrality by 2050. We see that the developing economies in Asia are reaching carbon neutrality way later than that, towards 2070. And India, for example, is reaching it in 2070. Some of the developing Southeast Asian economies are not reaching it within our outlook. But still, there is a way to make things better, and this is why gas is so important for the developing economies in Asia, because we still see a massive reliance on coal, and gas, in our view, is really the cheapest way to decarbonize these economies, to switch away from coal. And in fact, with a growing energy demand in Southeast Asia, for example, we still see gas share in the power sector will remain approximately the same in our 82 scenario in 2050 as it is now. So the share will remain the same because there's still growing renewables, but the overall volume of gas demand will grow as the overall energy demand grows. So gas, and particularly gas coupled with CCS, is going to be a great way to decarbonize the economies.
So Katerina, that's a really important point. And, it sort of reflects a question that one of our questions asked, which is, why should the developing world move from coal to gas? It could, it could leapfrog and bypass that technology and move straight onto renewables. I think the message you're giving, but I just want to make sure that this is clear, is that actually the reason that you got to move to gas, it's the only way that you can actually create a fast enough pathway to decarbonize in this part of the world. There is no solution that can get there that quickly using alternative technologies. And I think that's a very core message.
Yeah, and one part of this message is the speed of decarbonization, and gas will, as you correctly pointed out, gas will provide the opportunity to quickly decarbonize these economies. But the other part is the reliability. And we understand that renewables have high variability, and gas is really needed to provide this peak load, especially if we are looking towards the longer term, when there's a high share of renewables in the power sector, and gas is still needed to provide this flexibility. The other part of the question is the transmission networks and reliability of the grid itself. And in the developing economies, overhauling the transmission lines to prepare the grid for such a high share of renewables is expensive and it's difficult, while gas is there to very quickly help decarbonize the economies. And of course, there are always those additional issues with renewables like space limitations. Not everyone can afford big spaces for wind or solar plants, and there's also additional issues with some of the renewables. So for example, issues with environmental safety issues with hydro, for example, some cost considerations as well. So overall, we basically see that gas is necessary for quick decarbonization and for reliable decarbonization.
Thank you very much, Carita.
Great answer, Katja. The only thing I'd add to, which I think you touched on in your presentation, is it is a great opportunity for gas, but gas producers have to realise that they have to play their part of the bargain and reduce their own carbon emissions as
exactly, yes,
possible.
yeah, absolutely. So going greener, green LNG, carbon offsets, and so on, pairing CCS with the development, but also management Scope 3 emissions is absolutely key to make sure decarbonization works.
Yeah, for what it's worth, I totally agree with you and with Simon and Katerina on this. I think it is a major issue, and it's great to hear you say this, because I think that's a message that is not clearly enough enunciated in the world today, and it's something that ought to be shouted much more loudly, in my opinion. So let me just go back to the actual presentations very quickly. We're running out of time very rapidly. Big statements. The world needs no new oil supply. That's a big statement. Now, you've run a scenario. I mean, the IEA are actually in their recent report saying stop oil and gas development completely as of this year, which seems to me to be a little bit dramatic, but there we go. That's what they're saying. Clearly, there are implications between how oil companies can transition towards this new space for both renewables, energy, and obviously zero carbon gas. Is it really a case of switching off oil and switching on everything else? Or do you think that oil companies require the balance sheets of oil, at least in the short term, to actually transition? And if so, for how long?
Yeah, well, that's a question that has, if not sown confusion, then certainly solicited different answers across the oil and gas spectrum. But in terms of the way that companies are positioning themselves, I think most people would acknowledge that oil demand is going to be reasonably robust. For the next few years, and then eventually we'll go into decline. So there's potentially quite a bit of money to be developed or to be generated or made over the forthcoming decades, particularly if the oil price stays around $70 as it is at the moment. And as I said, companies are positioning different ways. We're just at the beginning of what will be, I'm not keen on this phrase, what will be a journey over the next few years. So at one end of the extreme, you've got companies like Ørsted, which used to have an oil and gas business, but hived that off and is now a pure renewables company. And when we look at the oil and gas sector, the real leaders on this are the BP. BP has got an extreme strategy relative to the other majors of planning to sell off 40% of its production by 2030, and it is a clutch of companies and incidentally invest increasing volumes of capital into renewables. You have a group in the middle ground, such as Shell and Total, which are having a very balanced approach to this. They still believe in oil and gas for the next decade and perhaps beyond. So that their approach is, as I say, balanced. And then you have, I'd say, the bulk of the industry, which is only gradually getting to grips with what on earth it does. I think the danger, if you like, is that we go through a period of price volatility. So investment in oil and gas is at a low ebb. It's the lowest it's been for 15 years. The crisis of 2020 pushed it down a little bit further. Companies are hamstrung by their stakeholders, your shareholders in particular, We want to see bigger dividends. I saw BP was the latest who had a big dividend increase out today, in fact. So they're not investing. And I do worry that you will see the price even higher over the latter part of this decade because of high investment. So I think that story that you played out there, Peter, has a little way to come. Our view is that before we get into an AET scenario, there is more money to be made in oil. You will see more investment, but you'll see a different type of investment. You'll see companies going for lower risk, maybe smaller projects, ones that, as I mentioned before, are lower cost and low carbon. You're not going to see the industry, I think, invest in the big oil projects that would take 5 or 10 years to bring to fruition and bring on stream. There's too much jeopardy in those. You don't know where oil demand is going to be in 10 years' time. You don't want to run the risk that the industry, or the problem the industry fell into earlier this decade or earlier this century, where costs blew out and the returns that started out looking like 15 to 20% ended up being single digit. We saw a lot of that. And I mentioned when I concluded that the industry is not prepared for the AET2 scenario we talked about. The industry hasn't been doing nothing. It has really sharpened up. So it may not be investing in gas as we'd expect to see, but they're being much more careful of what they will invest in, and are being driven much more by returns and value creation than volumes. That's not going to go away. It's all about how do I create value going forward.
Thanks, Simon. Let's move quickly on to oil price and the comments that were made about OPEC and the fact that obviously OPEC will take a greater share of production going forwards, but will lack price control. Now, obviously my inside message to myself here was yes and no, in that geopolitics always gets in the way of oil price. And, at the end of the day, this is a scenario that clearly shows that kind of dividing line between oil supply and demand, but doesn't necessarily model geopolitics. So my question here is, how real is this proposition that OPEC plus Russia will indeed lose price control, given the fact that that's quite a strong geopolitical bound if they've got 50% plus share of the market, right?
It's a really good question, yeah, and it's really predicated upon the oil demand view that we have. So if we have electrification happening at the pace that we have in this scenario, which is far faster than our base case, then OPEC's power will be challenged. We've not seen, I'm going to say to a degree, they would need to make there's some fascinating decisions that they would need to make if it became clear that the world was moving to peak oil demand far quicker than people thought, and we were into a scenario of global oil demand in decline. How they responded, because there's various levers. One could well be they try and maximize value by pumping hard to eliminate investment from others. It's quite nuanced as to what that could do, but what we've done quite simply is gone, demand is falling, it's falling through technology development and regulation. So even if the oil price is falling, consumers don't necessarily see that through fiscal taxes. The classic question we've had when we look at that reversible fortune is, surely you would just burn oil to compete with gas into power? No, because you look at the extra CO2 costs associated with that, the price relationship we had suggests actually that's not really much of an option for oil. How OPEC behaves in this transition will be fascinating to watch. So we've been quite conservative in our approach. Could they be far more aggressive if they feel there is greater value to be had in that world? We've seen some of those tracks before. What that could well do is drop oil price near-term oil price to much lower levels than what we had, to defer investment from others, that's a difficult decision to make on an NPV perspective. But the geopolitics of energy will no doubt remain, but move to the geopolitics of emission.
So, and adding to that, you talked a little bit about the premium for gas, obviously coming from oil. So effectively, we'll get to a situation potentially under your scenario where there is a gas premium rather than an oil premium. Are you seeing, or within your clientele, not only coal to gas switching, but potentially oil to gas switching as a result of that change in premium dominance? Because obviously that would be an early visual KPI of that strategic direction beginning to happen within the context of your scenario.
This is one for Katerina, but let me just pitch in before, because what we have seen over recent weeks, last month or so, is because of high LNG prices in Asia, fuel oil's back in the power mix. So but that's in locations where there are no carbon costs associated with that switch. So that's something we've observed from our short-term analysis of the short-term product markets. But Katerina, over to you.
Yeah, so we definitely know that there is switching in between fuels, and we see this happening in the Middle East, in Asia as well, and it will continue happening as mostly driven by the emissions, as Alan mentioned. The use of oil implies higher emissions in general, which could be a problem with CO2, with carbon price, but it also leads to additional emissions like SOx and NOx and so on. So even if we see the price of gas being at a premium, we don't believe that there will be substantial switching from gas to oil in the longer term because of all these additional factors.
Okay, cool. And just coming back to the region and gas, we talked about the Middle East, and we talked about obviously gas on the increase. Coming back to APAC, a recent article suggests that Malaysia is expected to contribute actually 12% of global natural gas production by 2025, given their ambitions to expand gas within the region. How do you see that playing out? Again, back to your zero carbon gas model, which will drive this. Is this going to put pressure, do you think, on the APAC region to really get its act together when it comes to carbon capture and storage?
So absolutely, the additional decarbonization pressures are going to have quite a big impact on the upstream production in the region. And mainly this is because there are a lot of discoveries in the area. There is a lot of gas, but there's also a lot of contaminants in this gas. There's a very high CO2 content of in these discoveries. There's also high hydrogen sulfide content in these discoveries. So basically, it is a problem, and it's also a problem because historically there's been a lot of gas vented, or a lot of CO2 vented into the atmosphere, which is something that can't continue, really, considering all the decarbonization pressures. And the other kind of problems related to this is that it incurs additional costs. And when you are in the fiscal system of PSC, where you basically get the revenue shared based on the sales gas, but roughly 20% of your produced gas is just vented somewhere, it still incurs costs, but it doesn't bring any revenue. So it is clearly the problem. And if you consider that now more and more companies are moving towards setting the net zero targets, so Petronas set net zero target for 2050, IOCs are setting net zero targets, finding a partner who is ready to commit to this kind of development is becoming increasingly more and more difficult. But there are still lots of opportunities, right? And the opportunities are driven by sheer fact that there's a lot of gas in the ground in this area, and there are a lot of depleted fields in the area as well that could potentially be used for the CCS, as a CCS. The problem here is that it's still very unclear who is going to pay for that. It's still very unclear how the fiscal terms would look like, how cost sharing would look like within those PSCs, who is going to cover the cost of this CCS developments and carbon capture and so on. So we believe that there are definitely going to be more challenges given more decarbonization pressures, and the governments have a very big role to play. They do need to step in, and they need to provide more clarity on the financial side, on the fiscal side as well. And there should be more private and public partnership to make it work. And eventually large opportunities, but do need a lot of help from the government and commitment from the companies.
Well said, Katerina, and thank you very much. And we're reaching the end of time, unfortunately. I could continue for a good hour or so more without a problem, but unfortunately we can't. Simon, would you like to make any wrap-up comments? I've really enjoyed the discussion. I think you've all been very open. The presentation was fabulous. And as I say, we could continue to discuss this for another hour. Simon, over to you to wind us up, if you may.
I'd love to come back and talk in a year's time, because by then we'll have been through COP26. We'll have got some of the answers to the questions that have been posted on chat, which have all been excellent, by the way. We'll see how the world is coming together, and the pace at which our industry in oil and gas has already adjusted in the last 18 months or so has taken me by surprise. I wouldn't be surprised to see much greater advances in the next 18 months. So I think it's all change. And hopefully, we're going to be heading in the right direction to get nearer to that 2 degrees or lower pathway. Peter, I'd like to thank you for inviting us on this. It's been tremendous to engage with your audience. Thank you all out there in Singapore and elsewhere for participating and being active in the discussion, and look forward to catching up again.
Thank you very much. And on behalf of the EI, I'd like to thank you and Wood Mackenzie for taking part. And you can be rest assured that we will be in touch in the early part of the year, if not before. We've got our International Energy Week coming up in London in the sort of February period, and that will be after COP26. And I would have thought that it would be very useful for you to summarize the output of where you're at with your scenarios post COP26. So let's do it. And thank you to the audience for some wonderful questions, which helped me sort of put the conversation together. We look forward to seeing you again soon. Thank you very much. Goodbye, everybody.
Thank you. Bye-bye.
Thank you, bye.